Good afternoon. A warm welcome to the Colliers webinar. My name's Len Rosso and I head up the industrial and logistics team for Colliers in the UK. We've got a packed webinar today and I'd just like to say a few thank yous, firstly to our panelists and then also to Jessica Middleton-Pugh, who's going to moderate our wonderful panel. The agenda is as follows: the introductions, then sector analysis and outlook, panel discussion and Q&A. So over to you, Jessica. Thank you.
Thank you very much. So I am Jessica Middleton-Pugh. I am a recently joined retail and residential correspondent at React News. And it feels like never a more appropriate time for someone writing about those sectors to be chairing an industrial webinar. With e-commerce dominating the market like never before, and the increasing importance of the proximity of warehouses and last mile logistic units to residential areas. And even before writing about retail and residential, specifically industrial and logistics has always been a favoured topic of mine. So very much looking forward to the discussion today. So now to introduce our panel. We have Jonathan Wallis, who is Development Director at Tritax Symmetry. Jono has more than 25 years experience as an agent and developer. His role at Tritax Symmetry is to add to and deliver their land portfolio capable of accommodating more than 42 million square foot of logistics space. Adrienne Howells, Development Director at GLP, has responsibility for delivering buildings from the existing land bank and acquiring new sites across England. And prior to GLP, she was head of warehouse expansion and corporate acquisitions for Lidl UK. Next up, we've got Justin Stead, who is currently the Chief Executive of Radley Handbags and Accessories and advisor to Desmond & Dempsey luxury pyjama brand. Both are London-based and backed by private equity investors, and Justin has big plans for significant growth across both of the businesses. And now onto our Colliers representatives. We have Len, who you've already heard from. So Len Rosso, who is head of industrial and logistics, has more than 30 years experience in the commercial property sector. And as head of the department, the team continues to outperform competitors whilst also advising clients such as IKEA, Amazon, and Ocado, to name but a few. And next we have joining us from the retail division within Colliers, we have Pierre Kunkler, Director in West End Capital Markets. And Pierre specialises in retail investment opportunities with a particular focus on high street, shopping centres, food stores, retail parks and mixed use investments, as well as fundings. And throughout his career has been involved in transactions involving more than £1.1 billion. And finally, last but very not least, we have Andrea Ferranti, who is Head of Industrial and Logistics Research at Colliers International. And he works closely with the research and forecasting team while supporting industrial and logistics teams nationally in providing research and advice to clients. So very shortly, I will hand back to Andrea and to Len, who will be giving a short market presentation, and then we'll be diving into our Q&A with questions from me and questions from the audience, very welcome in the Zoom Q&A chat function. But also, very importantly, we will be conducting polls to test the mood in the virtual room. So please be prepared for some audience participation, which we will be discussing, and then the results of these polls will also be sent around to you after this event. So now I would like to hand back over to Len and Andrea. Thank you.
Thank you very much, Jessica. So we got a fantastic panel discussion coming up. So I won't be taking much of your time here. Just gonna quickly go through some of the key findings and across a few slides we learned. To kick things off here, I'd like to discuss some of the latest economic performance here. So here we're seeing Q2 2020 GDP performance across most developed economies. The UK has suffered a sharper drop in Q2 2020 due to the fact its own links to social distancing, and there seems to be a strong correlation between a share of GVA of an economy and its economic performance. So we expect the UK economy to experience a steeper recovery all the way to 2021, where we could potentially get to the pre-pandemic peak. If that wasn't to happen, we expect to get close to full employment all the way in the middle of 2022. If we look at some of the key figures onto the next slide, which are more closely linked to the industrial logistics sector here, we wanted to show you an analysis from the Office for National Statistics, where we analyzed the average online weekly sales versus the actual increase relatively to February 2020. I should say that these figures are for August 2020. The September figures haven't been issued yet, although we got some estimates around the total sales for the UK, which actually increased by 6% like for like. But if you look at the online sales, you see that the overall share of online sales actually, the volume spent actually increased by 54% when compared to February 2020. But I think it would be important to look at the different store type performances. So namely here, we are highlighting food stores, non-store retailing, which actually comprises everything done online, primarily online, so the likes of Amazon or other smaller player. The sharper increase has been seen in the food store, where we saw about 87% increase when compared to February 2020, just highlighting the importance of this grocery supply chain in these difficult times. Len, I'm not sure if you want to add anything to this in terms of what you've been experiencing when dealing with clients.
Thanks, Andrea. Yeah, I think I'll just comment to say that a number of the occupiers within the e-commerce industry have been very active throughout the UK. A number of those sort of occupiers have been lucky enough to do deals with, such as Amazon, who've mentioned already, Pets at Home, who've been busy, and a number of other of those key occupiers, DSG. They've been very active in the market, and I think it's been more of a structural change. I think if you look at the sort of percentage of the online sales, it was traditionally at 20% year on year. And I think actually now that's grown dramatically over the last 6 months in lockdown. And we now believe it's going to be at circa 25% plus, which is in effect sort of 6 years growth in 6 months, which is obviously great for our industry going forward. Andrea, back to you.
Thank you very much, Len. Yeah, completely agree. We've seen like a acceleration of about 6 years or so in terms of when comparing to our forecast. But if we move on to the next slide, where we're going to be looking at take-up activity here. Here, what you're seeing is a take-up activity for distribution warehouses, 100,000 square foot plus, on a quarterly basis. So the first 3 quarters have seen huge demand. So we are set to reach a new record high for the UK in 2020. We are already 10.7% ahead of what we saw for the entire 2019, at about 34 million square foot transacted. So there have been some few themes here around there. There's been a flight to prime. Occupiers have gone for grade A space when possible. So we've seen about 52% of the overall take-up done on design and build unit, just highlighting the lack of supply in certain core markets in the UK. 21% was for speculatively developed schemes, which just goes to show how clever some developers have been in providing those vital schemes in key locations throughout the UK. The remainder of the balance, of course, has been second-hand. And here again, in 2018, we saw a record here. We definitely expecting 2020 to be, again, a new record. And about 30% of this take-up has been driven by Amazon, who's been very acquisitive in 2020. But then, again here, not only Amazon has been taking lots of space in the UK, we've seen several other occupiers, third-party logistic provider, a bit from the grocery sector, a bit from manufacturer. Is there anything you want to add on to that?
No, Andrea, I think, it's been quite diverse sort of level of occupiers have taken space. You've had DHL take quite a lot of space, XPO, We've mentioned DSG already. Amazon, of course, have taken space. I mean, there is a bit of a trend on this chart. If you look at, I suppose, the Amazon factor, as it were, who have been advised by Mr. Milner across all of these deals. If you look at it from 2014, they took about 12% of the market, and it was a record year. In 2016, sort of circa 16%, 18, you know, circa 20%, and then in 2020, we think it's going to account for 30%. That said, if you do take them away from this chart, it's still very positive figures, and it's still well in line with the 10-year average in excess of 25 million square feet, which I think shows the diversity and strength of the market overall. Back to you, Andrea.
Thank you very much. Now we can move on to the next slide. So here, because of course this demand has been driven by large deals, here I wanted to show you an analysis done by a deal count by size band. So here, as you can see, the first thing that jumps out of this chart, perhaps to my eyes, is the record-breaking level that we've seen for take-up on units 500,000 square foot plus. So occupiers are going for bigger units, sometimes higher units, to reach higher economies of scale and to defend margins and increase efficiencies. But on the other side of the spectrum, on the size band between 100 to 200,000 square foot, historically this size band always been very busy, has been the sweet spot for many occupiers. And it continues to be, as is shown here. So now we got about 61 deals done for over the first 3 quarters of 2020. And potentially we could reach the record that is shown here in 2018, or close to the 2019 of about 77 units. So we still have 3 months to go in terms of finalizing the stats, and there's still a lot of deals being discussed or under offer. If you look at the 2 size band between the 200 to 400,000 square foot, still it seems to be really busy, and we're expecting again occupiers going for these types of units as they try either to consolidate, expand, and increase efficiencies. But I think the next slide is going to talk about some supply side dynamics. Here, instead of showing you the usual static supply available at this point in time in the market, I just wanted to look at it from a different perspective. So there's been a lot of discussion around the provision of spec space. Some people have been saying that the market would have been oversupplied because of this huge increase in spec activity relatively to historical standards. So we have done some arithmetics just to show you that it's not the case. So in 2019, we've seen 8.5 million square feet delivered, ready for occupation. 2020, we're expecting this level to reach 7.1 million square feet because we got again 2 more months to go. So in total, the sector will have seen about 15.6 million of new space delivered onto the market. But if you look at the take-up activity, pre-let activity on those new spec schemes, we've seen that nearly, actually more than 7 million square foot of space has either been pre-let or let just after completion. Of course, sometimes it takes 3 months, it might take 6 months, sometimes some unit is let before completion, but the market has shown a huge level of net absorption. 2021 is difficult to actual pinpoint exact figures that we're going to end up with. But at the moment, we're tracking 5.2 million square foot of space, either under construction or scheduled for completion. Of course, some more schemes will start construction. Some other will be announced at the beginning of 2021. So we expect overall level of a new supply being delivered for 2021 to be in line with what we've seen in 2019 and 2020. So Len, again, on this point, if you want to add anything with regards to the supply-demand imbalances that we see in most regions, where sometimes we see 1 or 1.2, 1.5 years worth of supply relatively to the take-up levels.
Thanks, Andrea. No, I would just say there's some locations that's also got, zero supply available of existing stock and also sites coming through. For example, if you look at the Northwest, there's almost no buildings available of a new construction above 350,000 square feet. There's only one site if you want a unit of circa 500,000 square feet you could take there, which I think shows the constraints. I think if you look across the country generally for new units of in excess of 500,000 square feet, there's almost very little, if anything, available. There's been a large take up over the last, as you explained on your chart, over the last 18 months of the big box accommodation. So no, I think it's in really good shape, the supply and demand dynamic. Back to you, Andrea.
Thank you very much, Len. If we look at the next analysis here very quickly, just going to go through just to show you the rental dynamics over the past 10 years or so. So here what we've done an exercise looking at how rents as shown by the MSCI index have performed following the beginning of the global financial crisis. So the UK economy contracted for 5 consecutive quarters from July 2008, June, July 2008, and rents took a big hit because of that. And it took rents about 8 years to go back to the level that we saw in May 2008. So, but why this time around is different? So firstly, I'd like to highlight a few points here. So the first one is the vacancy rate is relatively low. We are at about 6.2%. This is compared to about 19% back in 2009. Developers have been much more better in providing space, key markets, key location, and more clinical and forensic when speccing new schemes. Finally, the most important points is that the economies now were put in induced coma rather than weakening due to cyclical drivers such as asset bubbles and debt cycles. So the sector is set to outperform, and we will see continued demand throughout the remainder of this year and the beginning of next year. So to move on, if we move on to our forecast is actually reflecting what we just said to this point. So the industrial sector will outperform all other UK real estate sector in terms of rental growth. So the blue chart is showing the 2020 forecast. So all industrial units will grow by 1.4%, with London and the South East outperforming. I'm not going to go through all these numbers because you can see them clearly. Before moving on to the last slides, I want to just talk about the retail bit. Of course, because of structural changes, consumer attitude towards spending online and different dynamics, social distancing measures, etc., we are expecting retail rents to take a hit at about 12.1% across all retail environment. So I think we are really approaching the end of this presentation. If we move on to the last slide before our concluding remarks, here I just wanted to highlight the net initial yield from MSCI data. We have taken a kind of longer history, just looking at prior to the global financial crisis. And as you can see, there's been a strong demand from overseas and national investors with money flowing into the sector, which resulted in a huge yield compression to about 4.3% prior to the beginning of the pandemic. Following the beginning of the pandemic in Europe, yields have moved out just by 10 basis points, but this is across all industrial hemisphere. So to conclude our last few points in the last slide, the economy is technically coming out of recession, but there are some downside risks, particularly around the labor market, potentially consumer spending, depending on unemployment rate dynamics over the next 12 months. The industrial sector will see a new record year take up this year, that is certain. In terms of investment activity, we expect investment volumes to pick up and potentially further yield compression, namely on single-let distribution warehouses in prime location. So on these concluding remarks, I'd like to hand you over to Jessica for our panel discussion. Thank you very much.
Brill, thank you so much, Andrea. And it's great to be chairing a discussion where we're actually talking about a record amount of take up and lots of, good news, or at least a little bit of good news that I think we all definitely need. So thank you for that and welcome to the panel. Jono, Adrienne, Justin, Pierre, and welcome back, Len. So I thought it would be good, first off, to hear from our developers on the panel, particularly on this point, as we're hearing, take up is so high, and at least for the short term, likely to continue as COVID continues to drive online sales. So, how are we going to battle that whole, 1 year, 1.5 year supply problem, even less in some regions? How can we develop faster and ease the pressure on that pipeline? Jono, if you wanted to kick off with that, please.
Afternoon, everyone. Thank you. Well, I think there's a number of ways to ease the issue. First is that we've got to start building again. And during lockdown, it's interesting to see those figures on speculative buildings. We have let 80% of our speculative builds during lockdown. We've only got one building left. That's 160,000 square foot out of the entire 33.4 million square foot portfolio. So that's not a bad void ratio, but it does also highlight the issue that's out there in the sector, and that building's got a number of names against it at the moment. So I think it's more of a structural issue. There are oven-ready sites that we can get onto and start building, and we've got our next phase of speculative developments in the pipeline and sort of on the starting blocks. But I think we've got to go back to the more structural issues with the system, and in particular the planning system, our approach to highways, our approach to utilities, our approach to the skills gap. And those are four areas where fundamentally we need the system to change if we're to get stock into the market quicker. Because at the moment, I think if take-up continues as we foresee it to, we're in for a long period of supply shortage. And some of those regions, the Northwest that you've named, for example, we're already at that stage.
Thank you. Adrienne, how's it been for you over the course of this year? And what's your view in terms of how can we get more spades in the ground, get more warehouses let, hopefully?
Yeah, thank you. I do agree with Jono in respect of what he said. We also have let a number of our speculative buildings this year, and we too have limited standing stock available. Fundamentally, planning is an issue. I should have had another 3 buildings in development ready as speculative developments by the end of this year. But unfortunately, we still 9 months later sit in the planning process for a reserve matters application. So yeah, we really need to work on the strategy for planning, etc. Just to touch on a point from GLP, we do have our G-Track fast track development program, which brings together the entire supply chain and an intelligent build system, which allows us to build quicker. So that is one aspect that we'll certainly be looking to take forward in the future. We also have an extensive land bank. We have 4 speculative developments in build at the moment in Lutterworth. So we're trying to very much keep on top of supply and demand as it is very positive at the moment.
Thank you. And Justin, you are our representative of retailers on the panel. How has this year been for you? And how have you found that shift from the property perspective of your business in terms of the high street presence you might have to now, this greater emphasis on online sales and the need for both warehouse space and hopefully a really efficient logistics network?
Yes, thank you for the invitation this afternoon. Glad to support the Colliers team. Yes, it's been a fascinating year. Look, I'm Australian and American, split half and half. So I remain very optimistic about the future. But it has been dramatic, to say the least. There's really 3 segments to it, really blunt trauma of what we've worked through, the consolidation period where we are now, and a return to a new world of growth, which we see is starting probably next summer. So we've taken this opportunity to absolutely reshape all parts of our business, whether that be brick and mortar, whether I don't see the death of brick and mortar, but the traditional structures and setup and approach has been shaken to its absolute core. And that's going to continue for the foreseeable future, particularly short term. Needless to say, digital has grown in a very exciting manner, which creates all sorts of opportunities, both direct to consumer and through digital partners and platforms. And then that has a knock-on effect in terms of warehousing, DC operations, logistics, and the all-important and progressive outlook in terms of operations, in terms of dropship, and not just here in the UK, globally.
Great, thank you. And then, bringing in Pierre, who, I think you've had a bit more of a core retail kind of capital markets background, but, now we're seeing a bit of a marriage between the different sectors in terms of retail and industrial, particularly with now potential focus on, out of town retail parks, one of the parts of the retail market that's still been doing very well, but the potential there for some of these older parks to be repurposed into smaller industrial schemes. So, do you think that could be the answer in terms of boosting the pipeline of industrial developments?
Thanks, Jessica. Afternoon, everyone. Yeah, I mean, it's definitely a theme which is being explored recently. We've seen a number of projects where it's being undertaken. In my view, I can see it happening, but not necessarily on a mass scale. I think a mixture of characteristics of retail warehouse units, which are probably no longer fit for purpose as retail, given possibly the age, the condition or the layout, probably means that they won't necessarily match the modern requirements of industrial and logistics either. Also we've got to remember, in a lot of the retail parks we've seen that have opened since the initial lockdown, ones in good locations have actually performed pretty well since opening again, whether that's underpinned by the bulky goods sector, DIY, sectors such as pets, for instance, have all performed well. I think what we're probably going to end up seeing is going to be what we term last mile retail warehousing, which is where retailers will identify allocations within their store specifically for online fulfillment. Supermarkets have been doing this very well for a considerable period of time now. On average, about 25% of each supermarket is focused purely on online fulfillment. So we can see that trend being evolved into the retail warehousing sector. I think one other thing to bear in mind as well for industrial landlords is when they're looking at these retail parks, particularly ones in stronger commuter locations around large urban centres, is there'll also be of interest to residential developers. So it's another party in the mix, potentially, who can pay keener prices than some industrial developers.
Yeah, bringing that back to you, Justin. I mean, your experience as a retailer is, potentially taking space on a converted or even, semi-converted out-of-town retail park, the answer to your space needs. And, if it's not that kind of solution, what else would you, if you had a call to arms now, what else would you want to be seeing from the industrial sector right now?
Yeah, it's interesting on that front. I think most brands and retailers are still, if we're in this consolidation period, we're taking a very cautious view. And as mentioned before, we see brick and mortar still a very, very important part of our strategies. And that includes the high street, but also off price. So the ability to convert certain out-of-town locations is going to be very important. We're definitely seeing her move that way in the current openings. Lockdown and local lockdowns are having an effect, but she has moved and she's moving through to a safer environment where she can access better parking, open spaces. That's definitely happening. So that will be a part of the future for sure. But I think overall, I think everyone's taking a rather cautious approach at this stage to consolidate where they are right now, repurpose their existing retail locations across all channels. That's whether it's full price with partners or in off price. And I think that period is going to take, again, 3 to 6 months to get over this particular peak in this Christmas opportunity. And where will the land be and the lie of that land early part of next year? So safer retailing, more open spaces will be certainly a part of the future. How fast that will accelerate, I still think that's an open question at this stage.
Thank you. And now time to get some audience engagement going. So can I get the first poll up, please? So given the economic challenges, do you all expect occupational activity to tail off in 2021? Yes, no, or not sure. While I give the audience just a minute or so to answer that, it'd be good to pick up on Len, just going back onto that out of town retail parks conversation. Is there an opportunity there for other occupiers in the industrial sector? Are we going to see, manufacturers moving into potentially smaller footprints, studios, that side of things? It's not all about the retail sector at the moment, as we know.
I think that's a very good question, Jessica. I think the honest answer, as Justin said, it's a little bit difficult to establish if that will happen going forward. And the reason for that is if you're looking at being a manufacturer or logistics or some sort of freight company or a 3PL, taking space on an out-of-town retail park, at the moment, the dichotomy is the current occupiers on that park will probably be paying a very high rent. So I can't see the landlord immediately dropping the rent to a level where you would get the two to marry up. And that's an issue, I think, as well, going for the change of use from retail to logistics, where, if it's somewhere out of town, maybe in the north or the southwest or maybe the Midlands, you might be able to get the two sort of rental levels to marry up with the yield compression. But if you then move to southeast and into sort of the London boroughs, generally the rents, I'm not a retail expert, but maybe Pierre can comment on that in a moment. We just can't seem to get to marry up the change of use from a retail to a logistics or a manufacturing. That said, I know a couple of companies have bought into that, and I think their long-term play is if it goes wrong for retail and they can't re-gear them and get some yield compression with the rents at the correct ERV rather than being above ERV, I think they've underpinned it with industrial values in the future. So I suppose what I'm saying in a very long-winded way, apologies, is that I don't see it really marrying up in the southeast or London, those sort of types of scenarios, but maybe in the regions.
Pierre, did you want to chip in on that before I get all Chris Tarrant and go to the audience response?
Yeah, no, exactly as Len says, really. You typically in the southeast, in affluent locations, trading volumes have been strong, and there's actually a relevance for having retail warehousing there rather than alternative use. And then going back to the point about as well about a lot of these locations, because they're affluent and have residual values, residential developers will also be interested in them as well as industrial landlords. So it's quite complex. But as I think we go further afield in the regions, there will be some opportunities to explore, I'm sure.
Fabulous. Can I see the poll response, please? So given the economic challenges, do you expect occupational activity to tail off? Thankfully, the majority of our audience, 62%, says no, which is brilliant and very encouraging. But so on that point, as you've said, it has been a lot of e-commerce driving that. So, what do we feel the long-term outlook for online sales is? Like, are we, Justin, from your point of view, will we see more exits from the high street? Are we going to go, there's been brands, obviously various ones in your sector like Aspinall of London have taken away from the high street. Are they going to go into online and warehouse space?
Yeah, I think to answer that, I think the obvious answer is yes, but it's a little bit more complicated than that and a little bit more complex. So as mentioned, blunt trauma, consolidation period of return to growth, and whatever that new normal is going to be, and that is still playing out. I estimate we're probably 30 to 50% through the phase of phase 2, which is this consolidation period. But again, it's very rocky at the moment. Zombie businesses, brands, retailers are going to be wiped out by COVID-19. That's already taken place. And I think it's going to take place even more aggressively over the next 90 to 120 days, depending how this peak Christmas turns out. And the whole curve of how peak is trading now is moving forward into November, softening in the first weeks of December, and then ramping up again in the last two weeks before Christmas, and especially that last week. But having said that, there are major silver linings to all of this, and optimistic outlooks that can be seen. And why do I say that? Well, first of all, COVID can be reviewed somewhat differently. It's a massive, massive accelerator, and it's a catalyst event to propel businesses forward positively in terms of re-engineering their brick and mortar, which has knock-on effects to warehousing and logistics. It's a massive pivot to direct-to-consumer online, but it's even more massive pivot into digital platform partners, Amazon, Alibaba, even other smaller platforms around the world, where your product and brand you may not have thought about previously, but it certainly is an option now. It's provided retailers and brands the opportunity to lower cost base, which again comes into warehousing discussions, which may actually increase in cost. It provides us the opportunity logistically to be more automated, more global in terms of our automation as well. And the logistics operational support has to be there as the business pivots towards a greater digital focus. COVID will allow businesses also to fast track international opportunities. So this call, we're focusing on the UK, but we're actually looking to expand our warehousing DC operations, both in the United States and in China and across Asia. So it becomes a global DC and warehousing question, which is hugely important. And as mentioned previously, the dropship capability. Brands like Radley, Desmond and Dempsey and others that I'm involved in, we're looking to uplift our entire assortments, put them on platforms, but do all the logistics and support, warehousing, etc., from our operations to support working capital reduction in retail partners and wholesalers. So that's a significant move for us as well. It provides brands new product categories to dive into depending on your audience. So that puts a different pressure on logistics and warehousing and operations as well. We haven't done apparel, but we're about to enter into apparel. So we have to have a different setup logistically and operationally to support that move based on the customers and the channels that we can go now into. And as you mentioned, Jessica, we are seeing competitors drop, and therefore the competitive environment in the new world that's coming next year for the brands that make it, I think is going to be very, very exciting. There may be reduced capacity based on reduction in consumer demand, but the opportunity to consolidate your position and grow through all of an opportunities, and particularly internationally through digital, it's probably the greatest period in my business to grow internationally with lower levels of investment than you've had to do previously. So all of that has a knock-on effect all the way through to this discussion around the warehousing and DC and logistical support that brands and retailers are going to require as this world moves into a new normal.
Thank you. And Adrienne, I mean, with your current and also former hat on, from that supermarket perspective, a supermarket's going to continue to be the darling of the industrial world, especially looking at the next few months. People have started stockpiling behaviors again. Apparently, I'm sure this must have quite an interesting impact on any kind of supermarket warehouse strategy.
Absolutely. I think, it is, as Justin said, an interesting time, and those businesses that can look to be agile and adapt will, have the ability to come out potentially stronger. As we mentioned before, 6 years of online growth in 6 months, that's incredible. But in terms of the supermarkets, I don't know if they are structurally currently set up for that growth long term. They have actively, come across this blip, and they've responded to it by probably putting a lot of staff in place. But whether that's a long-term way of continuing, I don't know. And I think that potentially their infrastructure will have to change to accommodate that, big growth of online demand in the grocery sector. When you look at the type of people that are now shopping for their groceries online, a lot of the older generations that wouldn't have currently considered it previously have adapted really well And you know, a number of them don't intend to go back to their previous shopping habits. And you know, maybe we see some parallels to kind of 2008, around that time, where shopping habits for grocery fundamentally shifted from your kind of weekly big shop to shopping more smartly and going to different places. And those disruptors, the discount retailers, you know, took advantage of that. And other retailers had to adapt and spend a lot of time over the years adapting to those fundamental shifts. And maybe we're seeing some parallels again.
Absolutely, thank you very much. So kind of looking now then in terms of, you know, the numbers behind the property, really, we've just chatting to Len before this event and saying how it's a great time to be an industrial agent, especially when you're starting to talk about some very sexy yield levels. So, I mean, Len, kind of picking up on this, are the current yields sustainable, do you think? I mean, you know, projecting ahead once there's a drop in online sales again, potentially, and other asset classes become a bit more liquid again?
I think absolutely. I think there'll be further yield compression. I think it is sustainable going forward. If you look at a lot of the transactions which are happening in the UK currently on an investment basis with logistics, everyone talks about the last deal, or is a record yield. But then the next good quality logistics proposition which comes to the market, which is with a good location, a good building and a good tenant on a lease of in excess of 10 years, if it's 20 years, that opens up to the annuity type funds. And, you know, for those sort of guys, if it's 20, 25 years, they have an insatiable appetite for those type of product. But even if you get back to the more standard sort of 15 years, I believe it is sustainable, and the yield compression will continue to happen for a number of reasons. One, most of our clients who we work for on the development side and the fund side generally are actually keeping the product they create, particularly when it's let to a great covenant, it's a good building and a good location. They're holding on to that sort of product. So generally there is less product coming to the market. And because of there is less product coming to the market, when something good does come to the market, generally you have all the key purchasers bidding for that. And, you know, that was something of a lot size, let's say just 100 million, for example. Not only would you have a number of the UK institutional funds bidding for that, but international money would be bidding for that type of product also. So yes, I think the answer to your question is, Jessica, as I said, I waited 34 years for this sort of moment to happen. So I believe the yield compression will continue due to the lack of product coming to the market, and also because of logistics is having a period where, you know, it's got growth, it's got great dynamics and supply and demand.
Thank you. And then picking up on that growth story, can I get the next poll up, please, for audience to get your fingers ready. So the industrial sector will outperform other real estate sectors in terms of rental growth this year. But what's your view for 2021 industrial rental growth? And in a moment, we've had a couple of questions come through on the Q&A function, so I will throw them out to the panel shortly. And if as soon as that question's timed out, if we're able to get the results immediately, that'd be great. Great, okay. So I feel like a measured response to rental growth, which I think is encouraging. And, you know, Pierre, would you see, obviously, you know, talking about this from an industrial perspective, but do you see that potentially continuing positive story about industrial coming to the detriment of what is going on in your retail sector?
Yeah, I mean, it's very interesting. Clearly, there's a wide gap between yields in the industrial and logistics sector compared with all asset classes in retail, other than food stores, which is just completely continuing to polarize, to be honest. Retail yields across warehousing, shopping centres and high streets are being offered at soft yields that we've never seen before in this market. So it's a really interesting time. Demand seems to be in retail for two different categories, either the long income perceived dry food store type, or to a certain extent DIY as well. We've seen some institutions like Hermes and Aberdeen acquire B&Qs recently. And then you've got the second category, which is demand for retail to repurpose it and take it away, either in whole or in parts, and reposition it as something else. Recently we've seen housing associations buying shopping centres to do that, and other major city centre sites which typically form retail but probably need to be reduced by quite a distance to make them competitive again. I think as it continues, as industrial gets more and more competitive and crowded, I think there will be more and more risk-averse investors who do look at retail and think, now these yields are at this level, is this now attractive enough for us to enter as a counter-cyclical play? I think the key will be understanding each retailer and also the ERVs, and I think ultimately that will end up driving those interested parties towards the more prime assets, but we can certainly see a bit of a theme happening there. One of the key elements though of that will be when the debt market's ready to get back into retail, which it isn't yet.
Thank you. So on the Q&A questions from the audience, bringing back in Andrea, who has been here the whole time. So if you want to comment on that yields discussion, Andrea, but also a question on some of the stats you gave in your presentation. Are these forecasts consistent with the latest developments in terms of the lockdowns and potential circuit breakers?
Thank you, Jessica. That's a really good question. So we finalized with our forecasting team, we finalized our figures just 1 week, 10 days ago. And while it wasn't certain of us that the UK could go in a circuit breaker or some other hotspots were experiencing lockdown measures, we were considering this situation. So particularly around the industrial sector forecast, expecting potential uptick again in e-commerce demand due to some sort of restriction coming into place, or people just not able or feel free to go out. So hence why we're expecting decent rental growth for the sector, while the economy is not going to perform brilliantly. With regards to the retail sector, I don't think 1 week or 2 week circuit breaker for retail perhaps might affect dramatically high street rents, because we are going in a phase of a long-term transformation where investors are repricing things, and at the same time occupiers are trying to deal with their cash flow. So hopefully 1 week of a circuit breaker for parts might not damage that much, potentially, if the government was to step in and provide them with extra liquidity. In terms of yields, yeah, we discussed that quite a bit, but from a macroeconomic point of view, I'd like to add the fact that if you look back in 2007 and 8, prime yields for the industrial sector were at about 5.5-ish. We were in a completely different world there. Different monetary policies, different money flows, different investor in the market, and also the interest rate was very high relatively to this day. So now investors can't really get their money working anywhere. If you consider that most of other sectors are not as liquid as they used to be in the past, you could see further yields contraction, further yield compression coming in.
Thank you very much. And then also from the audience, so an event or a webinar would not be complete without some kind of question around Brexit. But to Justin, so would a no deal WTO rules Brexit mean more, less, or the same space that you would need to take in the UK?
I don't think from our standpoint, the way we're pivoting our business and moving forward, that it definitely wouldn't create more. That's for certain. Whether it would create less in our particular businesses, probably not. I think we're pretty neutral on that, the way we're reorganizing our brick and mortar as we exist today. The bigger effect around Brexit is the continued access comfortably, seamlessly, in good manner for the international client, particularly in the luxury and affordable luxury areas, to access the UK seamlessly. And a wider discussion, not for now, is the VAT and what the government has decided short term to eradicate the VAT recovery schemes for international tourists and clients leaving the country. So that has a big impact on retail, certainly short term. And so Brexit, in terms of my opinion right now, we're neutral on it. We're not as exposed in certain ways, either from a supply chain or how we view our, from the European perspective, and access to that market, even reversing to that market. So I would say we're neutral at this stage.
Thank you. I mean, Len, picking up, we've actually had some quite optimistic spreads about the market in 2021, but that's maybe sometimes when we're just thinking about the COVID-19, let alone thinking about Brexit. Does it impact, dampen your enthusiasm for 2021 at all?
No, not really. I mean, I'm internally optimistic about the logistics sector for all the reasons everyone's spoken about on this webinar today. The lack of supply, demand dynamics. Of course, yes, it will affect the economy, but I think the logistics sector will not be immune, but I think it's going to be pretty robust. So I think I would say my overview on it is confident about the outlook for logistics, even with what we're going to go through from a Brexit perspective.
Great, thank you. And then consistent with the conversation we had about how the outlook in the year was about industrial, putting it at the top of the list in terms of property sectors. There's been a lot of change over the years in terms of what these warehouses actually look like, the client expectations, and also, the on-site offices, amenity, green space around sometimes in some cases that are being offered. So kind of thinking all that in mind, it'd be good to go to the next poll to get the audience opinion on this. So particularly, with everything I've just talked about, and then also sustainability high on the agenda, do you think occupiers are willing to foot the bill for a truly sustainable building? Yes, no, or not sure. And I think this, a good opportunity to bring in, Jono, you're in from that development point of view, and all of those needs you're now needing to factor in. Are you finding, how does it impact that development process, and are occupiers willing to pay?
Thanks, Jessica. I think the first thing is that we need to give ourselves as an industry a tap on the back, because without a doubt we're leading the way in this. If you look at what the house builders are doing, it's nothing compared to what we're doing. And I know that we're members of Gold Leaf member of the UK Building Council. We've recently made a commitment to build all of our new buildings to carbon neutral in construction. We're on with our first one, the DPD pre-let in Bicester. We've got Scott Hughes advising us on BREEAM and carbon. So it's right at the top of our agenda, and it has to be, for both being a responsible developer and the way that the industry is going at the moment. Will an occupier pay for it? I think to a level. At the moment, we're building it as standard in our buildings. You do have occupiers who want to go that extra mile, and for everyone who's prepared to pay for it, there's another one who sees the price and then pulls back. So it's certainly increasingly high on the agenda. But you do have to remember that, especially with the 3PLs, we're dealing with companies who operate to very low margins, so they have to take everything into consideration. But at the moment, we're not giving a choice, because we're doing it as standard.
Great, thank you. Can I get the results of the poll, please, to find out what the audience thinks? So split, yes and no. I guess it depends on maybe the occupier. I mean, from your point of view, Justin, getting the sustainability right and the bells and whistles of everything a warehouse could provide, are you willing to pay more for that, or do you just want a shed that does the job?
I think it's an interesting, looking at that poll, I find that a little surprising actually, because every forward-thinking business not only has a business requirement and a consumer-facing expectation to be greener and sustainable, And it's just based on the state of the global environment that we've created. But I think more forward-thinking businesses and leaders, we have a moral and ethical duty to be doing the right thing here, based on the mess that's been created. Therefore, I think tenants are going to have to be especially alive to this fact, and that's going to knock onto landlords as well in this space, because we're organising ourselves to be carbon neutral in the next 2 years. We have certain mandates. We're working with the BRC and their drive, and other administrations around around the world, in fact, that we're signing up to. So our industrial partnerships, we may be in a position soon where we won't be signing a lease to a retail location or a retail park or a mall, or even a facility for our warehousing if it doesn't have certain green credentials. And are we willing to fit all those costs ourselves? Possibly. But we'd be looking to what Jono said there. We were looking for the partners to say that they're on the same mindset anyway, and they've got that implementation in place, or at least to a pretty advanced degree, because we feel it's a business requirement, a customer expectation, and the way things are, it's a moral requirement.
Thank you very much, and thank you everyone who have put questions into the Q&A. And sorry, we've not had time to answer all of them, but it's already been quite a whistle-stop tour through so many topics. But one of the questions that's come in, I'd like to spin very quickly into my final question to all of you, starting with Adrienne. So, the retail sector has seen various disruption, but what, for the industrial sector, what do you think will be the next? We can say it was a risk, but actually say potentially a positive opportunity in the coming years that you think could shake up the industrial and logistics sector.
So yeah, positive opportunities. I mean, definitely, for us moving into this sort of new sustainable world, and looking at those buildings and what our customers require. Sorry, I had read the question as being a risk item, and that would be really boring things like planning and power. But with really boring risks comes opportunities, and as I say, with sustainability, looking at new options for powers, new technologies, new partnership ways of working with supply chains and people and customers to ensure that we remain agile and meeting the needs and staying ahead of the game in the future. So yeah.
Justin, so one risk, but let's a more positive message of disruption coming to the industrial sector from your point of view as a retailer.
Yeah, I think things are moving, and as we've all realized, COVID is a massive disruption and dislocation, but it's also a huge amount of opportunity. And you tie that into everything else that's going on in the macro world, all the way through your supply chain, through your logistics, through your operations. It's all got to be knitted back to matching to the consumer demand and where the world is going. So, I think there's huge opportunities here, and I'm actually very positive that as long as logistics and DC and all the operational pieces are in sync with the commercial realities of the world and the requirements of those commercial realities, there's got to be great opportunities for people to work together and to move forward positively. We try to communicate right down through our whole logistics operation, but also right through to our suppliers, right through to the sourcing of the goods for our businesses, to make sure that they're in sync with what we're seeing and what we're doing and what our shareholders want as well. And we are committed, absolutely committed, to a very positive and proactive ESG strategy, I should say.
Brill, thank you. Johnny?
I think the main issue is that we've got to persuade government to take logistics seriously. It still has a historic view of the sector of some dirty industry, low-paid jobs, no jobs, wrong type of jobs, and too often it's housing is seen as a priority at the expense of the industry. In the recent white paper, I think there were, well, I don't think, because a colleague told me, there were 97 mentions of homes, there were only 4 mentions of jobs and 3 were in the forward, and there were no mention of logistics and no mention of warehousing. And that's just not right. When logistics has to be seen as part of the national infrastructure, government aren't linking housing with logistics. And when you think that every new house puts up creates 69 square foot of logistics demand, we need to look at that. We need to join it up, and we need to drive the government to understand what our business is doing and how important we are to the national economy.
Yeah, absolutely. Thank you. And Pierre?
I think on a similar theme to what Jonathan's saying, government intervention is where hopefully there's hope and risk for us, but particularly on business rates. I mean, it's a drum that's been banged for many years now, and something which has just continually been kicked down the road. The holiday until March has been warmly received, but there needs to be fundamental change in how it's structured and how it affects retailers and the retail industry. But there is reasons to be opportunistic. I mean, I was just before I came on this call, one of my colleagues told me he'd done 3 deals every day this month on the occupational side. So there is stuff happening. You know, we've seen IKEA announcing they're going to be taking 50 new stores. The likes of Superdrug, Sky rolling out stores who Colliers act for and do a lot with. You've seen also the likes of Lidl say that they're going to be closing the online business and focusing on bricks and mortar. So it's not all about online, it's not all about closing physical stores, but we desperately need government help on the business rate side, that's for sure.
Great, thank you. And now, as I hand over to Len to just give his comments on that question, just a good opportunity to close the Q&A. Thank you very much to all of our panelists. I thought a really interesting and diverse conversation, and thank you very much to the audience for dialing in. So Len, over to you.
I think most of the panelists cover it there really, but I think it was summed up, I believe, by John or Justin, that obviously whilst COVID has been a massive disruptor, it's given lots of great opportunities. And I think that's one of the key things. I think the government has to step up to the plate, as Jonathan has said already, and actually not only just from a job, talk about it, it's a big industry, but also I think, you know, from a planning side, which we touched on. So I think that would be it from me anyway. I think we've also overrun a little bit. So what I would just like to say is a big thank you to Jessica from React for being a great moderator, done a great job, Jessica. Our panelists, to Adrienne Howells of GLP, John Wallis of Tritax Symmetry, and Justin Stead of Radley. It's been a great panel today, and I want to thank you all for your time, and of course from the Colliers team, and of course to our viewers logging on to watch this webinar. So on that note, thank you all very much.
Great, thanks Len, thanks Jessica.
What is it that defines us? Is it the clients we represent, from global brands to small businesses? Is it the expert advice we provide to property owners, occupiers and investors? Or maybe it's our data and innovative technology giving our clients the upper hand. At Colliers, we prefer to define ourselves not by what we do, but by how we do it. Wherever we are, we believe we succeed only when our clients succeed. It's what drives us to achieve more every day. We believe in collaborating with our global colleagues to achieve the very best results. In thinking and acting differently to find innovative ways of solving difficult challenges. In investing in long-term relationships, connecting with our clients as people, not corporations. And in always doing the right thing. We're experts, we're creative, we're passionate, ambitious, and enterprising. You can define us by all of these words, or you can define us by just one. Colliers. Wherever you do business, we're there to maximize the potential of property and accelerate your success.